Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, September 27th, 2024. It's 4:03 Eastern Time, so the markets are now closed. This one will be very brief. Let's just keep it limited to the stock market primarily, but I do want to cover the VIX as well, highly, obviously very related to the stock market, tends to move inversely. And I will also, let me just add in there NVIDIA, because to me, NVIDIA is still the single most important stock in the universe right now, certainly in the stock market. So I also made mention in the previous video, but there wasn't time for it. I'll just quickly, I want to look at, show you something on the Nikkei, the Japanese Nikkei index, stock market, look at their history, and an update on UNG. All right, so we'll do it in that order. So starting out here, the S&P 500 via SPY, the tracking ETF. This purple line, that is Fed day right there. Remember, the initial reaction was slightly negative, a lot of volatility. The next day, the market decided they liked the 50 basis point cut, that it wasn't a bad thing. And since then, you can see, again, that's the post-Fed, Thursday's candle breakout. And look where we closed. If I put the crosshairs, we closed almost exactly on where we closed that day. The doji, the skinny part, the body, that shows you that the range went higher, lower throughout the day, and we closed where we opened on Thursday. And today, this red candle means we closed at the bottom of it, so we closed. So the whole net gain since the Fed pop is zero. We went sideways for over a week now, and ended up back where we started right there. So you can't spin that as bearish. The breakout itself put the S&P in new highs, took out that little minor downtrend line I had on the 60-minute charts. But it's not very bullish either. There's just not a lot of buyers on the other side of it. And if you followed me for a while, if you've heard me say this once, you've heard me say it 1,000 times. Breakouts that occur with overbought conditions and negative divergence have a much higher rate of failure than those that don't. And so what we'll watch for next week, this little minor uptrend line. Let me drop down in the 60-minute charts. There's the 60-minute chart. Remember, this was going into the Fed. I had a little minor downtrend line. There's the Fed noise in and around it. Thursday, we gapped above it. And again, we closed today where we opened and closed on Thursday right there. So moving sideways in the indexes. And even though you did at one point make a slightly higher high intra-week, you can see the momentum indicators, which are right here, the PPO and the RSI are both diverging, as well as the daily, as I showed you, the daily time frames. We have divergences across the board on all the way out to the weekly charts. And like I say, divergence is not a sell signal. What would be break of that minor trend line there, and then much more, I want to see the breakouts fail in both SPY and QQQ. We'll get to that right now. QQQ, the Nasdaq 100 tracking ETF. Let's just start out on this daily time frame. Sort of what I call a busy board, a lot of lines here. But there's the purple right here. That's the Wednesday. There's the post-Fed breakout. And we did manage to close a little bit above it. Most of the gains, we were going sideways until yesterday. Market got excited with Micron's earnings. And they whispered AI, and things went crazy. AI bubble's still in effect. However, the leader's still well off the highs. We'll get to that in a second here in the video. Minor uptrend line right here off the lows, just like you had a minor uptrend line here. You go up, and then boom. So this is kind of, this is a uptrend, downtrend. We were able to cover both those lows, post, long setups there to go long. And this will be once we have a solid break. Technically, we closed above that, below that trend line. Let me show you what it looks like on the 60. 60's busy, my 60-minute chart, that is. I've got a lot of lines in here, but I'm just going to draw over and show you the ones that are most important. There's the all-time high right there, the recent high bearish engulfing candle that we got on the daily, sell signal after that with the trend line break, and et cetera, et cetera, et cetera. August 5th lows, long, scale back in short from here to here, swing it down. We hit trend line and a lot of other support levels there on many key stocks. And everything else. So that was, and we had that bullish falling wedge. I highlighted that broke out. Give us another long entry. I've mentioned it as an objective short here at the downtrend line again. But but not adding above. But again, my trading plan, not becoming overly concerned or or planning to scale out of just what's still a mild swing position, was mild going into the Fed. And as I said, maintained, no reason to add to it, go above. It's the other way around. If we keep going higher, subtract to that. But we'll see when the time comes. Sometimes I'll change my mind for whatever reason, but I'm going to go over that. And there's a lot of moving parts. It's not all about one index, even if you're trading that index. It's about what's going on with the stocks within there. If there's time permitting at the end of the video, maybe I'll go over the Mag 7 if you're interested. Otherwise, I'll just end it after we cover UNG. So, the other thing, okay, so I have two trend lines. Again, it's been, with the Fed, you get that kind of a lot of volatility. This is the lowermost or benefit of the doubt uptrend line, like I just showed you on the daily a minute ago. We just closed below it. Nothing really impulsive as far as selling goes. This was an alternative trend line I had off that reaction low. Either way, we're below both of them. Most importantly, we're coming off that divergent high. And, we're still if you go bigger picture, well below my market top range from back here. As expected, post-Fed. Told you if we got 50, we'd probably see S&P 500 get up in the top half of its trading market top range that I laid out in June, which it did. And it is, and it never, still hasn't violated that top. And I said we'd probably go back into the bottom half on QQQ, which we did. So, again, we'll see if it plays out next week. I need to see a reversal, and all the better if and when this triangle pattern, these two lines I just drew here, this uptrend line and the downtrend line, if we can fall back below there, that should be really nice. Way better, even better, obviously, if we take out 448.72, give or take, about 448.50. And then if that happens, that's still a major reaction low everyone will be looking at, but I think the damage will be done right there to kind of seal the deal, if you will. I'm talking about opening the door to my longer term targets on the weekly chart, T3, 4, 5, 6, and 7. And one of the things I find interesting is the small caps. The small caps, remember, they peaked back in 2021, so they're still have not taken out their previous bull market high from a couple of years ago, and are still below. This is just the recent high in late July, bearish rising wedge, sell signal drop. We had a subtrend line breakdown, back test there, another drop, and recently had a little minor uptrend line here. So what you can see here is this is Fed day right there, Wednesday of last week, right? Yep. There's a post-Fed pop, everything popped. Algos were buying, the computers are buying, humans were buying. But there was they faded it consistently throughout the week. We had a little bit of drift up the last 2 days, but I find that interesting. So pretty much we brought it back down to where we were before we went into the Fed. And I say this because no other sector should benefit as much from lower interest rates as the small caps, unless those in the know, the pros out there, think something's wrong, because as I said, 50 basis point cuts typically come at, they can be bullish for at least a while if the economy is hunky-dory. But even though these are the most interest rate sensitive stocks, the small caps, much more interest rate sensitive than large caps because they're dependent on borrowing, that should have really been a catalyst. If nothing else, maybe even, why are they not trading at all-time highs like the S&P or even close to their previous highs? And again, the fact that we're drifting down would say that maybe the market's pricing in, a recession, because you can bring rates to zero in a recession. It doesn't matter. These guys are going to feel the pain more than the big caps. So either way, worth noting. And that's it. Let me move on to NVDA. Again, let me show you the 60-minute chart of IWM before we leave there. This is what my 60 looks like. You get the divergent high, wedge, trendline break, drop. That was the August 5th lows. Cover everything, go long, rallied up. There's a trend line we took out post-Fed. There's the breakout, no coincidence, that and ended with clear negative divergence, just like you had a divergent high there. There's your divergence lines. Trend line break, drop. Here, I don't have a super well-defined trend line. We could kind of do that a little bit. Yeah, we could say that. Either way, it's moving down off that divergent high. If it happens to next week, rally a little bit. Again, if it happens next week and not too much later than that, we get there pretty quickly. If you extend these lines, you'll still have divergence on the smallies. And if they do much more than just a marginal new high anytime soon, then they could burn through that divergence and then go on to take out that high and maybe the other one. But as of now, that was a divergent high, could mark the beginning of the next drop, more than this little drop, as would that. But anything much more, again, would be technical. From a technical perspective, nothing but, hard to spin as anything but bullish. But all right, there's your smallies. And then the big dog here, NVDA. Again, NVIDIA peaking way back here with a bearish engulfing candle back in June. The king of all things AI, poster child of it. Still below that high. There's the downtrend line off the highs. Here, let me drop down to a 60-minute chart. All right, 60-minute chart right here. There's that all-time high, bearish engulfing candle, downtrend line. And although all the indexes and SPY, IWM, QQQ took out their downtrend lines recently, this did not. Even the semiconductor sector itself did. And maybe this will play a game of catch-up. But again, usually when the leader of an industry dies and is lagging behind, it can play a game of catch-up, but that's typically not a good sign. So all I can tell you definitively, other than so far we continue to get rejected at the primary downtrend line, which was also and is. That's my, the short scaling zone. I told you I shorted the first tag of it and then added another lot yesterday. Was it yesterday or the day before? Because that's, part of it was my trading plan, and you can't second guess it. I wasn't crazy. I'm not all in yet. The semis are still above trend. I'll get to that, even though I didn't say I would. I need to cover that. But that's it. But, wash, rinse, repeat. If you look at this chart, you'll see on here, and these are all things that were laid out in advance. We had a divergent high, then the sell signal. These were the three targets down here on the 60-minute chart. Target zone 1, 2, and T3. And that ended. It wasn't mere coincidence. We went long that morning, covered all shorts, went long, and we had positive divergence or divergent low. Gave us this catalyst, the technical catalyst for this rally that ended with a divergent high, negative divergence. We fell down. Remember, we covered it again because it was at the same primary uptrend line on the daily chart, which you don't see here on the 60, both these levels. And you also had the bullish falling wedge pattern and a divergent low. So this is swing trading, and thing's been a cash cow lately. And again, this is, hey, if it breaks out, then let it go. It's a stopped out trade, and this divergent high didn't play out. But as of now, that's what you have. Divergent high at resistance. I don't ask for much more than that when looking for an objective short entry. Would be a heavy hard short if I saw SOXX failing at resistance and other things. And right now it's just a moderate short with room to add. So here's SOXX, the SOXX semiconductor sector ETF. Also a divergent high, bearish engulfing candle, primary downtrend line, which was pop post-Fed like everything else except NVIDIA. And we can drop down to a 60-minute chart. Had divergence there recently. I highlighted that, and we pulled back. We back tested. So again, you can look at this glass half full, glass empty, but it was a breakout. Breakout never failed. We had a divergent high. We back tested, another thrust up. But this is what I'm watching right now for next week on the semis. And you might want to set a price alert. You got a beautiful little short-term uptrend line. The divergence that we had the other day, it's simply extended. It gives you a price channel here. And so I'm taking the divergence lines. We have equal or lower highs on the indicators. That one's a spike, little spike higher. But for all intents and purposes, you've got the divergence there. Definitely a steep uptrend line on prices too. At resistance, I'm gonna borrow or move this line. I had it at 236.50. But if you look closely here, you can see there's that previous reaction high. Traders always focus on those pivot highs. And I put it right there, and that's pretty much where we stopped this week. So, if the semis can power on through, this divergence doesn't have a lot more room before it's taken out. So that'll be bullish. And again, it should be a net plus for NVIDIA. because birds of a feather flock together. Inflows, everyone's buying Micron and AMD and everything else. You're flowing money into the semiconductor ETFs or the Nasdaq 100, and then proportionally, NVIDIA gets a share of that. It's just kind of like almost like the mafia. It gets its cut due to its weighting in the index or the sector ETF here, which can help offset other flows. So, in other words, people taking profit on NVIDIA. But either way, those are levels to watch. Price alert. We'll set an alert now. I think I already had one, but no big deal. We got nice. This is really nice resistance here. You had a previous high, breakout, backtest, failure, tried to get back above it, rejected. So it's more of a resistance zone. And again, we stopped at the bottom of it today. So if the semis can get much above that 242, that's hard to spin as anything but net bullish. You still have a big old gap there, comparable to the gap that I started out and highlighted on QQQ. But like I said, every tick higher from here chips away, but doesn't eliminate the bearish case. But it really starts to when you get up there. As of now, tomorrow, if we can break down, or Monday, we can break the trend line, and then way better if we can fail that breakout above the primary downtrend line. It's going to be a little ways to go to get there, but that's what I'll be watching for next week. And that brings me to Mr. VIX, the VIX Volatility Index. This is a 60-minute chart. Somebody asked for an update the other day, and I gave you that. We'll get to the futures. I can't remember if I gave you this one or the futures, but either way, you can see here, remember, the VIX, I found over the years, most of the time it's just noise. Stay away from it. Don't even talk about it or focus or try to trade it unless you can make a pretty good case the stock market's about to make a major turn. In other words, if the VIX is very high, it's been on fire, spiking up to the top of its trading range or price resistance, then you want to get ready to short it because it falls like nobody's business once the trend is out. That's time we hit that T5 level right there and the bottom, and that was, again, you want to, typically I told you, will usually exit the VIX longs a little bit before or right at, not after I close out my short trades when I'm shorting the market. So because that's the nature of trading corrections and bear markets. I love it. It's like being long with the fast forward button hit 2 or 3 times. In other words, you can make a lot more money in much shorter order in a bear market or a correction, simple correction in a bull market, because stocks tend to fall a lot faster than they rise. But you can't be too late, to the party. You got to, book profits and get out quick. Recognize when the thing's likely to turn. If in doubt, maybe scale out early or trail your stops down. So same thing. The VIX, as quick as it can go up, it often falls just as fast, right, on the downside. However, what you can see here, and this is, I gave you these targets recently after that previous trade right there. And they're still, so far so good. We're making higher lows, and so, somebody mentioned today, and it's fine. Somebody's like, Dow, new all-time highs. And okay, well, the Dow's, it's only 30 stocks. It's closer to the S&P. And remember, the S&P is what the VIX tracks. It tracks the futures, puts and calls on the S&P 500. So let me go to the VIX itself. I just showed you the VXY as an ETF or ETN to trade it. So when I drill down to the 60-minute chart, we had a divergent low. That's where we went long before on that last trade when we were short the equity markets down into the August 5th lows. There's August 5th. No coincidence that the VIX peaked when the day the stock market bottomed on August 5th. It was a hard reversal. But then we put in that divergent low right here. You can see on the 60-minute chart. And then, boom, we had a blip. That was that last correction, that last drop down that we traded on QQQ and then reversed again because QQQ had a bullish falling wedge right there. But it was on the VIX. The spot VIX we're looking at here was a 62% spike in the VIX. And of course, keep in mind, if you're new to this, you can't trade the spot VIX. You can't buy it. You can only buy derivatives of it, which are futures that track it, or the options on those futures, or the ETNs or ETFs that roll those futures. So that's why I showed you VIXY, and I'm going to show you the VIX futures there in a second. But anywho, divergent low popped 62%, another divergent low, and a breakout, bullish falling wedge. I believe this is what I showed on the update the other day, and if not, I'm showing it to you now. This isn't really anything much for today. It's more for something to watch next week. So I'll just say it. Based on this, it looks like tomorrow, maybe even out of the gates, we could finally see the post-Fed breakout get faded. Today ended the week after. Remember, the Fed meetings on Wednesday. I said everything that next day, Thursday, Friday. It takes about a week or so. Usually by now, and I said it, the VIX will usually by the early mid next week, or this week, the week after, kind of pick its direction, but it didn't. That's why I started out the video showing you the S&P 500, which again is the closest thing to the stock market, or one of the closest. Closed exactly where it, popped the day after the Fed meeting, the first full trading day. So the market hasn't chosen a clear direction yet, in my opinion. You want to give it near-term play-by-play call, give it to the bulls right now because you did break out above the downtrend lines. But again, if this is only going to go up if the market most likely if the market drops next week. The VIX again tends to go up when the market drops. So, and you have my targets. I'll give you the longer-term targets there. Let me show you the future, and you can see the targets even here. And even if you can't trade the spot VIX, it's good to keep an eye on those levels. For kind of, this is busy. This is my daily chart here, but it's so messy, so many different lines here. I'm gonna just get back to that 60-minute. Let me show you the futures. Okay, these are the front month contracts, the October 16th VIX futures. This is what I believe when somebody asks me for an update. It's the same thing on the spot VIX pretty much. And that's what I just covered there with the 60-minute chart. You had a divergent low there. There was that pop, ended right here. Then we had another almost equal, slightly higher high that gave us negative divergence, just like you had positive divergence at that low. That negative divergence sent us back down to what's a pretty well-defined support level on the futures here, VIX futures, 1760-ish. And then recently broke out. We back tested. And then boom, we hit. This is the first target zone I posted the other day. Let me see if I screenshotted that one. Yep, there it is. Yeah, I would have posted it, I guess, in the comments section, or I don't know, maybe I covered it in the video. Divergent low at support was on the 25th. There's the date right there, 2 days ago, Wednesday. Divergent low at support, followed by a breakout and current back test of the wedge. This will most likely happen, these arrows, these bigger moves up, if Thursday's breakout and SPY, QQQ, and SOXX fails. So far we've hit that first target. That's where the arrow breaks are, that target zone, and that was good for roughly about a 10% or so lift up there. Right to the top of it too, 1944. So come Monday, like Jimmy Buffett's song, come Monday, if we gap down in SPY and we close the day red, especially build on those losses, this is where the VIX is going, next stop. And then this is just a short-term 60-minute chart. We could certainly go up higher. And like I said, if those breakouts fail, then and we take out the levels I started the video showing you and I've been talking about on SPY and QQQ, especially QQQ, yeah, we're going to go, the VIX has the potential to explode again to the upside. But first things first, let's see what happens Saturday. If the market's going to be green all day, we're probably not going to take out this today's high, and which is resistance. All right, let me show you the Nikkei real quick. I mentioned this the other day. The Nikkei is the Japanese stock market, Nikkei 225. Here's the year breaks. I'm going to scroll down. You're not going to see it. I'm just going to show you. This is 1985. This is the peak right here in the right around the end of 89, 90. I'll get to that. I'll scroll back down. Let me try to do it and see how much I can fit in here. Yeah, I can get it all in there for you. Okay. All right, we're good. So you can see the year breaks. I mean, it might be hard in the video unless you're looking at a big monitor, but all right. So and again, it's like everything, like most indexes, it trades well to the technicals. We had a very clear bearish rising wedge, blow off top. It looked a lot like the Nasdaq 100 did back in the dot-com bubble, leading in the 2000 highs, and not too much unlike. You'd have to take it off. It's a sense not the same as the S&P now, but similar to Nasdaq, and it's definitely stocks like NVDA and stuff. Either way. All right, so I encourage you, if you're not familiar with what happened And remember, this is Japan. This isn't some banana republic. This is one of the G7, one of the largest economies in the world. They had very similar situations. They had a real estate bubble, everything bubble, credit bubble. And then the Bank of Japan started, they pioneered, I don't know if they pioneered it, but they did zero interest rate policy and quantitative easing. A lot of things we did when when the financial crisis hit. But the key is they refer to it as Japan's lost decade, because you had a bunch of zombie banks and other things. And so when you look at the stock market, it's really, even though they call it the lost decade, it's 2 decades. So here we are. We peaked back in 1990, and there's a point when I'm bringing this up. We're not really trading the Nikkei. You can if you want, but so it peaked back in 1990, and I'm going to use the crosshairs here. It fell from there. Let me do it this way. I'm going to grab the highs. I'm going to pull down to the lows. You can see the to the left there, it shows that it was an 82% drop into the 2009 lows. So most other stock markets follow the U.S., and so we had our financial crisis here. But again, it wasn't random that it just followed us down. They also had, like the S&P did. Remember, the S&P 500 had every single reason, the same technical postures it does now. It took a while to build for years. And we had the high was back in November of 2007 in the S&P and Nasdaq 100. And when we had a bear market, there was a 55% plus drop. So, and they had the same thing. It just ended their multi-year. And again, you're talking going back to 1990 all the way down to 2009 low. And then the thing is, they didn't get back. They just recently got back to where they were. What is this, 2024? So we're talking, 35 years of flat to no returns, or really much flat returns. And so, okay, what's my point? My point here is a couple things. I'm going to show you a few more things on the chart, but I can't tell you where the U.S. stock market's going, but I do believe that in the coming decade plus, we're going to see something similar, and that's based on many, many factors. I could sit here a lot. I do talk in the videos, but so when the turn finally comes and the gig is up, and what's going to be is, I think it'll finally, the Fed has gotten just crazy. It's like the Fed gone wild, like those old Girl Gone Wild videos from the 80s. It's Fed gone wild. They think they can, and they have been, and it worked great. I'm talking about money printing, quantitative easing, manipulation of the financial markets. But now you've got a federal government that's spending. We know our debt to GDP ratio is at dangerous nosebleed levels, and all the while, when they're telling us, at least the current administration, the economy is doing great, and a lot of economists are saying, "Oh, the economy is great. I'm blowing slow." God forbid what happens when we have a real severe recession. We don't have any dry powder left. And it's insane to me. The Inflation Reduction Act and all the CHIPS Act, and they're pumping all this stimulus into the market at the wrong time. It's like a doctor. You come into, you walk in to see your doctor, and all of a sudden he throws you on a gurney and pumps you full of epinephrine and all kinds of antibiotics and puts you on a ventilator. It's like overkill. You're gonna, patient's gonna be, put enough epi in you. You're gonna jump up and run around for a while, but you're gonna kill the patients. Or like running the car at the red line in the race. You've lapped the other cars. You don't need to do it. You don't push the car to the red line. You're gonna blow the engine. Back off a little bit and skate in. So that's, it's insane right now that we're getting all this stimulus. And so it's going to have long-lasting implications. Is what I'm getting at. And look. So here's the takeaway. If we see anything even remotely close to this is what I expect. Rolling bull and bear markets. So I want to show you something because I'm sure some of you, Andrew, you're so bearish long term. This will be a field day to trade. Here's the technicals. They're all marked up. You can see these lines down here. All these are your divergence lines. Positive, aka bullish. Divergence at the lows. Positive divergence. Positive divergence. Positive divergence. Look at all the inflection points. Just follow the arrows. And now I'm going to measure these for you. So here's the trends. The divergent high ended with this divergent low. That rally ended with a divergent high, divergent low, divergent high, divergent low, divergent high, divergent low. It was clear, it was strong. It didn't take long. But then that gave you that divergent high, divergent low. Okay, now I'm going to measure these out for you. So this is the point I'm trying to make. So I'm going to grab that high. I'm just going to show you what these trends were. And so what these are, this is a secular bear market, and these are cyclical bull and bears within. And that's, as a swing and trend trader, that's what I look to game. So you put me in a secular bull market, and I will game the ups, I'll game the downs. That was a 64% drop, followed by, and again, there were technical reasons to reverse there, 60% rally, followed by a 44% drop, followed by a 62% rally, cyclical bull market, followed by a 63% drop. Okay, you get the point. 138% rally, 62% drop. No, we'll just do this last one because that's a big one. Almost 200% rally. So if we've been in an era of buy the dip. Where passive investing has outperformed active fund managers. Most people have given up on actively managed mutual funds, and a lot of asset managers, hedge funds have been having a tough time. Everybody knows it's hard to beat the market, and that's leading to a potential bombshell. And a lot of people are saying the problems with index, all this indexing, it's going to blow up one day, and it can blow up bad. And so all I'm trying to say is, if you're of that mindset, and again, if you shouldn't be here if you wholeheartedly believe that Jack Bogle's buy and hold could buy a low-cost index fund, tuck it away forever. If you think now is a good time to do that, then more power to you. But looking at historic P ratios and other valuation metrics, and more importantly, if you're new to the site, and I say this often because I just don't hear it being talked about. I'm sure others do, but I don't follow a lot of others. But this is a secular. We just finished. This is the 30-year Treasury bond, or you can look at the 10-year. It looks the same. And we had interest rate rising, bull market in yields, meaning higher interest rates heading up into the early 80s. And then we embarked. That's out goes Carter and comes Reagan. Early 80s. Volcker busted inflation, and you had a very clear and well-defined downtrend in interest rates, and the 10-year bond looks the same, and these are yields. And then you had these few spurts. The only thing you could see these spurts here. This was the first. There was a financial crisis in 08, and the Fed had the first. Hey, man, this is cool. We can take rates to zero and use this thing called quantitative easing and inject all this money in. And they, it kept working. And then COVID hit. They're like, screw it. Let's go all in. Let's just print insane amount of money, take rates back, print a tremendous amount of money, inject liquidity in the system, go back to zero on interest rates, while the federal government does fiscal stimulus, we'll do the monetary stimulus, and it'll be double bang. We got that. And so, but what happened in here along the way is, and I've talked about this many times, by every technical measure, including higher highs and higher lows, and taking out the primary downtrend line, we ended one of, if not the longest, I don't know how far these charts go back, but this is 40-something years, almost half a century, of a secular bear market in interest rates. And this is just economics 101. Lower rates are bullish for the stock market. They, lower the cost of capital. Two things happen. So companies are more profitable. New companies start up. It's good for the economy. It's easier to start a business when you can borrow at 5% than it is at 15%. And there's another thing that happens in addition to the economy being strong, is that it's the alternative. When you can get, as you did back here, 15% on a guaranteed treasury bond, you do it. When you can get 10%, and a lot of people do it. So there's not a hard number, but it's incremental. And the higher rates go, money then moves away from, why risk to make them, and average, 10%. Stock markets average 10% a year for 50 years, whatever it is. But you're risking those 50+% bear markets that we've had every so often, or even more in recent years. We get at least a 30 something, or big 20. Why risk losing half your money to maybe make or average 10% a year? And so what happens, and it will happen, and it's happening, you'll see it happen. There's still a lot of liquidity sloshing. We've entered a new, I believe, secular bull trend. We've ended a secular bear trend in rates, new bull trend. Now, whether it's, the next leg up starts here, we go down here. I'm talking now longer term stuff where you really need to, at least I think, 401k money, if you've got 10 plus years to retirement, what's going to happen to the U.S. stock market if this is the beginning of a new uptrend in interest rates? The Fed can't control this. They control the ups and downs, but they can keep the federal funds rate at zero. They can do that. That's what Bank of Japan did. They kept rates at zero or even negative, but they can't control the long-term rates. And so, anywho, that plays into all this. So let me get back to that Nikkei, and then we'll move on and wrap up with natural gas. So if we see anything even remotely close to this is where swing and trend trading will vastly outperform the buy and hold investor. And it's been almost too easy for too long, and it's hard to say when that ends. But based on a lot of things, again, such as valuation metrics, a business cycle, and then the increasing federal debt that's going to will at some point or later. They talk about a flashpoint. We don't know when it's going to be, but you're going to have the bond vigilantes just stop buying U.S. Treasuries when our debt to GDP ratio gets too high. We can't service our debt anymore, especially if longer term rates don't come down significantly, because the U.S. continues to have new Treasuries come and due, and they have to reissue new ones to pay for the ones coming due and all the interest on those. So there's all of that. So there it is, guys. And this is what I'll, always keep in mind. I have, in my head kind of, the current technical posture on the U.S. stock market, just like, by the way, the Nikkei, you can see here, watch, rinse, repeat, right? You can see the divergence has been building all along here for the last couple of years, just like the U.S. stock market. So where do you think the next big trend is? There's no sell signals here yet. First one's going to be on a break of this minor trend line in the Nikkei, and then this one. And again, the Nikkei roughly follows the U.S. market, and all these, the bigger trend has been down, and they've gone nowhere for, decades now, back to where they were then. But, we've had these trends in the U.S. stock market, the up and down trends, the 2007 to 9 bear market, the ensuing bull market that we've had in the U.S. since, but then the correct, like COVID right there. See, it's all there too. So anywho. It's just big picture stuff. This is my monthly chart of the S&P 500, and I'm just going to circle. You don't get on the monthly time frame very often divergent highs or lows. Lows are bullish. Divergent high, bear market. These are the durations. Divergent high, 51% bear market. Divergent high, 58% bear market. Divergent high, 15, 20, 35, and so forth. I didn't measure out that one. The Nasdaq, of course, you have typically bigger drops. And so basically, this is the current technical posture right here. We have this divergent high. That last one, by the way, was only on the RSI. You can see right here when we had this drop earlier. So I have two boards. I'll show you. This is another board. There's a minor trend line here, and you can see we have these longer term trend lines. And then if you turn everything off, just when that time comes that we're going to be in the next a bear market, this is a great trend indicator here, that 20-month exponential moving average. It helps to find bull and bear markets. And the last bear market that, it was too late before the Fed started coming in, and, that was the financial crisis. We spent most of the time below it. And again, so these were the last bear markets that, COVID would have been much worse, but the Fed and the federal government, I call it Ursa interruptus, bear market interrupted. It was a 36% drop. But it happened in 6 weeks, and then they exploded the economy with money. And so it really never got to play out more. But we were below it, closed below. It was a 1 month candle. So there was the 2000 to 02 bear market. And it's once you get under it, you can see short rallies back to it. And in a bull trend, you're above it. You buy So this is why I'm talking about my long-term indicators. That's one that hasn't flipped, but again, turn on the lines based on the technical postures. It's coming, but first things first, and that's why most days I just focus on the 60-minute charts, and once in a blue moon I'll update these. I'll talk about this more when we start testing those levels again and their risk of being taken out. All right, last but not least, UNG is just treating us nice lately. I said this one, and I wanted to update it because we've got some potential. Well, we have negative divergence, and so it's really worth noting here. Nothing's changed in my outlook. I still think that's very bullish that we took out that basing pattern there, the W pattern, and I still think that increases the odds we're going to go up to these longer term targets. Natural gas, like I often say, when she wants to run, she can really run, and she will quite often in a strong trend just burn right through divergences like they're not even there. So remember, divergences aren't sell signal, but it is at resistance. We're at the top of my fifth target zone already. So many entry points that I've listed. There's no one way to say how much it's up, but in the futures up more, but that's about 30% right there off the lows. And as I said recently, if the divergence plays out, remember, every resistance level on the way up, price target was resistance. Those are all potential areas where it could pull back, but I still, like the last time I mentioned, we pulled back. This is a nice, well-defined uptrend line. And if we do pull back that far, it's also going to come in with the top of the trading range, which is price support. So if we get a pullback in the next week or so, that's an objective entry. What I've done before I went home today is set a relatively tight stop on it's a little more than half of my contracts of NG, and so that way if we do pull back over the weekend, tonight, later today, or on Sunday when the futures start trading again, it'll stop me out of partial position, which I'll re-enter. But I want to hold on. I don't want to be out all the way because, again, from my experience, I've done this. I'm recognized some big trends, had aggressive price targets, and got shaken out, and then boom, it just went up. So again, I've been pretty heavy on it, and still am at the moment, but set some stops a little bit below the reaction low we had earlier today, wherever that was. Got the some of the futures. So anyway, I want to point that out, and that would be if I do get stopped out and we do get back down there, that would be my re-entry point to buy back those shares. Anything more than that, you can use wider stops, but that's the ideal level. Not much below there for pullback, and I'll comment on it if it happens next week. Let me try to quantify it for you. If we do, that's going to be a drop of about 8%. So still, you might not want to ride that out, or you might if you're going for T8, which is another, shoot, off the bottom, if T8's hit, it's going to be about a 70% run. Now, let me show you one last chart, and that'll be the natural gas futures long-term chart. Okay, if you're new to the site or you weren't following this one before, I've been harping on natural gas on the long side for a while, and I like anything, I'll trade it short and often do when it tells me to. This is a longer-term chart, a weekly chart, so every candlestick's 1 week of nat gas, the futures. We call it the continuous contract, where they just splice in all the contracts that are rolling. 2005, 2006, 7, you see. And I've measured out, and you can see, again, all the divergent highs and lows are marked, and overbought conditions are marked, and things like that. And just to show you the trends, this was, I didn't measure the down, but the up here, that was a 222% rally. That was 158%, 234, 207%. Right here was 561. You can see the measurements there. And so far, and this is where I've been harping on, because this was a long-term, we hit long-term support recently. We had some support there, and I mentioned it, and we did bounce. We had a tradable bounce off that first pullback to the $2 support level. But we came down and I said if we failed 2, we have even better support down there at 150, and that's what we hit. And so far, since we hit the 150 level, and that's where we were, last going long, it rallied about 110%. Again, these are the futures. And that's what, if you're trading futures, that's what you're getting. UNG does its best, but it's got fees and expenses and slippage and all that stuff. But either way, based on the scope of the divergences. That's big divergent low. That's bigger than this divergent low here. And we didn't even have the divergence then on the RSI, only on the PPO, but you still had a 207% run. So just keep that in mind. The 563% run, that was with, Ukraine's invasion of, or Russia's invasion of Ukraine, and natural gas prices went wonky. Is it possible? Yeah, but I'm not looking for that. But I do think, we can power on up. And if we take out, this is a support resistance zone right here at about 350 to 380 or so. If we can pop that, this is where I think this run can run up to about $5 there. And that's going to about double it. We're at 275 right now. So I'm just showing you longer term. And again, based on this divergent low, as much as, we already went up 110%. Based on previous runs, 207, 234, 158, 222, 500 and something. See, there's probably quite a bit more there. But as I often say, don't fall in love with her. She'll burn you. This is, I call her the widowmaker. Natural gas, fewer commodities can put as much money in your pocket in short order, and fewer can take it away as fast. So I went over stop, loss levels, support levels. Can't pick one for everybody because list multiple entries. I myself, I'm in, out. I micromanage, I manage positions. And so, cost basis changes on each lot. Anyway, I'll keep updating this one as long as I think there's opportunity there. So that's it. There's your wrap up. Watch next week. See what happens as we come out of the gates. Like I said, the VIX looks primed to run but the stock market's going to have to show us something on the downside. We're going to have to start fading all those post FOMC gains and then some. And if it happens, the thing about it can happen fast. So just be ready. And if it doesn't, decide if you have any short positions on the market or any of these stocks that I talk about, semis, other things that are correlated with it. They're going to go that way too. A lot of the securities I share are highly indexed and correlated with the stock market. Some have almost no relation, like those auto parts stocks today, and some others. And that obviously the healthcare stocks tend to march to their own drumbeat, but they're going to tend to move with XLV. But today the three I gave you were what were they? The big the healthcare companies. HCA closed right on the trend line, almost a stick save. THC did get a stick save. It closed right back above. Should point that out, but sticking with it. No reason not to. And again, UHS still needs to take out that S1. So, anywho, let me wrap it up here. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great weekend.